Welcome to this video. We will focus on the tools used to identify appropriate investments for individuals based on their risk tolerance, managing investment portfolios, and evaluating performance results. It will cover essential topics such as risk profile questionnaires, asset allocation models, benchmarks, and the efficient frontier. A risk profile questionnaire is a crucial tool for assessing a client's tolerance for risk and selecting suitable investments. These questionnaires typically include questions on risk tolerance, investment experience, and time horizon before the client will need access to funds. For example, a risk tolerance question may ask how an investor would react if the market dropped by 25%, whether they would do nothing, sell shares, or buy more. Questions regarding investment experience might inquire about the types of investments an individual currently holds and their level of knowledge, ranging from none to extensive. Additionally, time horizon questions help determine if a client plans to access funds in the short term, less than 3 years, or over a longer period. Based on responses, investors are categorized into one of 5 risk profiles: conservative, moderately aggressive, or very aggressive. These rankings are then applied to asset allocation models to design a portfolio that aligns with the client's risk tolerance. For instance, a conservative investor would score low on the questionnaire, indicating a preference for capital preservation over potential high returns. In contrast, an aggressive investor would score high, demonstrating a willingness to accept market fluctuations for greater growth potential. Many brokerage firms, such as Schwab and Fidelity, use these questionnaire results to recommend tailored asset portfolio models. Asset allocation is a fundamental investment strategy designed to balance risk and return by distributing a portfolio across different asset classes, such as stocks, bonds, and cash. Diversification is key to reducing risk, as different asset classes do not always move in tandem. Asset allocation is beneficial regardless of whether an individual invests in individual stocks and bonds or through mutual funds and exchange-traded funds. Investment portfolios can be categorized based on risk tolerance. Conservative portfolios primarily consist of fixed-income securities with minimal equities to protect the principal investment and limit exposure to market fluctuations. While equity holdings are included to offset inflation, the primary objective is capital preservation. Moderately conservative portfolios increase equity investments while reducing fixed income holdings, offering better protection against inflation and the potential for additional income through dividend-paying stocks. Investors following this model accept slightly more risk in exchange for potentially higher returns. Moderately aggressive portfolios, often referred to as balanced portfolios, maintain an even mix of equities and fixed income securities. These portfolios are suitable for investors seeking both capital appreciation and income while maintaining a moderate level of risk. Typically, investors in this category have a time horizon of at least 5 years before needing access to their funds. Aggressive portfolios, on the other hand, focus predominantly on equities, with minimal fixed income investments. Investors who adopt this strategy prioritize capital growth and accept increased market volatility. This portfolio type is best suited for those with a long-term investment horizon of at least 10 years. Very aggressive portfolios consist almost entirely of equities with little to no fixed income exposure. This investment style is ideal for investors with a long time horizon, often young individuals, who can endure significant short-term fluctuations for the potential of high returns. Although these allocation models mention broad asset categories, a well-structured portfolio should also include a variety of investment types, such as domestic and international funds, small, mid, and large-cap equities, and various grades of debt securities. One essential aspect of maintaining an asset allocation strategy is rebalancing. Over time, market fluctuations, investment returns, and account transactions can shift the proportions of assets in a portfolio. Investors should review their portfolios at least annually to ensure their asset allocation remains aligned with their target strategy. If necessary, adjustments should be made by selling and purchasing investments to restore the portfolio balance. In taxable accounts, investors should consider potential tax consequences before making trades, whereas tax implications are not a concern for retirement accounts. Benchmarks serve as reference points for measuring investment performance. Typically, they are based on the performance of relevant indices that closely match the composition of an investor's portfolio. Choosing an appropriate benchmark helps investors assess whether their investments are performing in line with comparable funds. It is advisable to focus on long-term results, such as 7-year trends, rather than short-term fluctuations. Common benchmarks include the Dow Jones Industrial Average, DJIA, the S&P 500 Index, the Russell 2000, the Dow Jones Wilshire 5000, Lipper Fund Indexes, and the Barclays Capital Aggregate Bond Index. The DJIA, for instance, tracks 30 companies representative of the U.S. economy, while the S&P 500 encompasses 500 large U.S. corporations, making it a widely used measure of market performance. The Russell 2000 Index, which tracks small-cap companies, is useful for evaluating aggressive stock portfolios. Lipper Fund Indexes provide benchmarks for various mutual fund categories, compiling data to help investors compare fund performance. The Barclays Capital Aggregate Bond Index, previously known as the Lehman Brothers Aggregate Bond Index, is a broad measure of the bond market. The efficient frontier concept maps out the optimal balance of risk and return for different investment categories. Investors can use this model to gauge how well their portfolio aligns with an ideal return-to-risk ratio. Monitoring investment performance involves regularly reviewing account statements, noting changes in value over time, and comparing results against selected benchmarks. Brokerage firms often provide analyst reports with recommendations on whether to buy, sell, or hold investments based on market conditions. Additionally, reports such as SEC filings, including the 10-K, offer valuable insights into a company's financial health. In summary, investors have access to various tools and resources to make informed investment decisions and ensure their portfolios are performing as expected. If faced with fraudulent practices, regulatory protections are in place to safeguard investors. While investing can be complex, it remains one of the most effective ways to grow net worth over time. By understanding risk tolerance, asset allocation strategies, benchmarks, and performance evaluation methods, investors can make informed choices and build portfolios that align with their financial goals.